So how exactly do you memorize the absolute maze that is fringe benefits for the LECPA and actually keep it in your brain for 3 whole years? Look, if you're a BS accountancy student right now, I know that is literally your biggest anxiety. You're cramming massive amounts of tax law, and the fear of it just evaporating before you even sit for the boards, yeah, it's real. But hey, you're in the exact right place. In this explainer, we're totally ditching rote memorization. Instead, we're going to build a cognitive cheat sheet. It's a strictly logical framework that maps out exactly how fringe benefits work in the Philippine setup. We're wiring this into your brain so retrieval is instantaneous on exam day. Welcome to the explainer, everyone. I am so incredibly pumped to have you here. Today, we are completely cracking the code on fringe benefits taxation, grossed up monetary value, and those tax-exempt de minimis limits. We're going to rely purely on structured logic and mental anchors. Because here's the secret. If you understand the why behind these rules, you won't need to cram them later.
All right, here is our mental map for this session. 1. Who gets taxed, how? 2. The GUMV calculation code. 3. Valuation rules made simple. 4. De minimis benefit caps. 5. The excess flow rule. And 6. A LECPA rapid bullet review.
Let's dive right into section 1. Who gets taxed how? Okay, before we even think about doing any math, we have to know exactly who we're dealing with. In Philippine taxation, the title of the employee literally dictates the entire tax treatment of their fringe benefits. You've got to brand this fundamental fork in the road right into your mind. On one hand, if an employee is rank and file, meaning, they don't have the power to lay down managerial actions or use independent judgment for hiring and firing, their fringe benefits are subject to the graduated regular income tax, or IIT. It just gets tacked onto their normal compensation. But if the employee is managerial or supervisory, giving them a fringe benefit triggers the fringe benefit tax, the FBT, and that is a final tax paid by the employer. So, rank and file equals regular tax. Managers equal fringe benefit tax. Simple as that.
Moving on to section 2, the GUM calculation code.
So now that we know managers get hit with the fringe benefit tax, how do we actually calculate the thing? I promise you, the grossed up monetary value is just a simple logical sequence. First up, visually anchor this number in your head right now, 35%. This is the general fringe benefit tax rate in the Philippines for regular managerial and supervisory employees. When a company gives a manager, say, a car or a house, the government wants 35% of the grossed up value of that specific benefit. But wait, contrast that with this number, 25%. This is your specific exception rate. This massive 25% rate only applies to a non-resident alien not engaged in trade or business, which we usually just abbreviate as NRNETB, who happens to hold a supervisory or managerial role. If your exam problem mentions an NRNETB manager, your brain should immediately flash a bright neon sign that says 25%. All right, so how do these rates actually plug into the formula? It's a quick 3-step breakdown. Step 1, find the monetary value of the benefit. And don't worry, we'll talk about how to find that in just a second. Step 2 is the gross up. See, because the employer pays the FBT, the benefit the manager receives is actually considered net of tax. To find the gross amount, you divide that monetary value by 65%. Why 65? Well, 100% minus the 35% tax rate leaves you with 65%. Make sense? And if it's our NRATB friend, you divide by 75% because 100 minus 25 is 75. Finally, step 3, multiply that newly grossed up amount by your FBT rate. So either 35% or 25% to get the final tax due. Find the value, divide to gross it up, multiply to get the tax. Boom.
That brings us to section 3, valuation rules made simple.
Back in step 1 of our code, we needed the monetary value. But, a house isn't cash, so how on earth does the BIR value it? The ultimate trick here is usage versus ownership. Let's break down the housing rules. If the employer leases a house for the manager to use, the monetary value is 50% of the rental value. Now, if the employer actually owns the house and lets the manager use it, you take 5% of the zonal or assessed value, whichever is higher, and then take 50% of that as your MV. But catch this last part. If the employer actually transfers ownership of the property to the manager, the MV is 100% of the acquisition cost or zonal value. The core logic? If you just use it, you get hit with a 50% rule. If you own it outright, you get hit with the full 100%. And this brilliantly illustrates how the exact same logic applies to vehicles and travel. If the company gives the manager a fleet car to use partly for business and partly for personal stuff, the MV is 50% of the value, which, by the way, is the cost divided by 5 years. But if the company hands the manager cash to buy a car or directly transfers the car's title into their name, bam, 100% monetary value. As for foreign travel, business trips are generally exempt, but the absolute second the manager brings their family along, those family expenses become fully taxable as a fringe benefit. Now, what about loans? Listen up, because this is a classic board exam trap. If an employer gives a manager a loan with 0 interest, or honestly just an interest rate lower than the market, that is a fringe benefit. The BIR benchmark rate is strictly anchored at 12%. The taxable benefit is simply the difference. So if an employer charges an 8% interest rate on a loan, that remaining 4% they didn't charge, yep, that is your taxable fringe benefit. Always, always measure against that 12% anchor.
Let's move to Section 4, De Minimis Benefit Caps.
De minimis basically just means things of relatively small value given for employee health, goodwill, or efficiency. Think of this as the tax-free safe zone. I literally want you to take a mental photograph of these exact numbers right now. These specific peso limits are heavily, and I mean heavily tested in the Philippine LPO. Uniform allowance is capped at 7,000 pesos per year. Laundry allowance is 300 pesos per month. The rice subsidy, which is super common in the Philippines, is tax-free up to 2,000 pesos per month, or 150-kilogram sack of rice. Medical cash allowance for dependents is 250 pesos a month, or 3,000 pesos a year. If employers stay within these exact limits, it's 0 tax. And it totally doesn't matter if you are rank and file or the CEO.
Which leads us perfectly into Section 5, the excess flow rule.
So what actually happens when an employer is feeling a little too generous? This is arguably the most critical analytical part of this whole explainer. Think of this process like a financial waterfall. Listen closely. An excess in de minimis does not automatically mean fringe benefit tax. No way. First, the excess spills over and flows into the 13th month pay and other benefits bucket. Second, that entire bucket is checked against a hard cap of 90,000 pounds. It is only when the combined 13th month pay, bonuses, and that de minimis excess overflow the 90,000 pound limit that the remainder finally becomes taxable. And here's the kicker. That excess over 90K is always taxed as regular income tax, regardless of whether you're a manager or rank and file. So the waterfall goes excess, then 13th month bucket, then 90K cab, and finally regular tax.
All right, home stretch, Section 6, LECPA Rapid Bullet Review.
We have covered the logic, the formulas, and the waterfall. Now, let's initiate our final memory lock sequence. This is your ultimate cognitive cheat sheet. Run through these with me and lock them in. Number 1, rank and file means regular tax. Managers mean fringe benefit tax. Number 2, the standard 35% FBT rate always pairs with the 65% divisor. Number 3, the special 25% NRN ETB rate always pairs with the 75% divisor. Number 4, the BIR employer loan benchmark is strictly 12%. And finally, number 5, any excess de minimis flows right into the 13th month bucket, which has a maximum tax exemption of exactly 90,000 pesos. Now, to keep those analytical gears turning long after this explainer ends, I want to leave you with a real-world application. Imagine you're auditing a company that gave 5,000 pesos monthly rice subsidies to its managers. How would you trace the tax? Remember, the limit is 2,000. That leaves a 3,000 peso excess every single month. So does that automatically get hit with the 35% FBT, or does it flow into the $90,000 waterfall first? Think about the logic we just built. If you can answer that confidently right now, your 3-year retention is completely secured. Keep studying smart, keep relying on logic over memorization, and you've absolutely got this. I'll catch you in the next explainer.